Übertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Hello and good afternoon. I welcome you to today's weekly market outlook here for Admiral Markets. My name is Jens Klatt and I'll be the moderator here for the upcoming 45 to 60 minutes. We want to have a look at what's driving the markets at the moment. So it's in the morning I called it Squeeze Friday. Some of you probably recall the bigger squeeze on the upside we've seen when the DAX made it up or back above 11,000 points last week, resulting in a move which pushed us as high as 11,250 points. And after yesterday, after the ECB, took a while, but with the delay, the question surely arises why this delay. I think there's a good reason for that, and we want to have a look into this in a few seconds then, because it also is important to know what potentially caused this delay in this squeeze higher in the DAX and the push lower in the euro, with the trade negotiations going on between the US and the Chinese here, and it's very important for the upcoming week to have this in mind. But now, yeah, well, look at the chart. Currently, we're trading around 11,300 points, and it wouldn't come as a big surprise, especially if U.S. equities keep on trade higher. And even though yesterday has already shown it's not necessarily important that the U.S. markets push here. Yesterday was a quite neutral day for U.S. equities, and nevertheless, DAX showed some strength into the evening, continuing with the strength now today. So there's a good chance that probably we're not yet done on the upside. That probably we can move as high as 11,550 points. If not today, then probably in the next week of trading. If all developments keep on happening as we need it or need them to happen then. But before we start, very important, we have to have a look here at the risk disclaimer first. So trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. For anything else on this topic regarding risk and risk disclaimer, feel free to check out the website from Admiral Markets, where you find the risk disclaimer here too. Then there is, again, something which is already in effect since August, but nevertheless still interesting and important for retail clients. There's now a differentiation between retail clients and professional clients, which has some impact on the overall leverage, especially, which is used, not necessarily or not limited to the leverage, but nevertheless, this is the most important aspect for many retail traders out there. So now there's a leverage restriction for retail clients with a maximum of 1 to 30 for Forex majors, 1 to 20 for exotic currency pairs. We want to have a look, by the way, at such an exotic currency pair, CAD JPY. There's a very interesting seasonal pattern currently going on, and it's in fact highly profitable. I want to give you some insights on this seasonal trade. Some of you probably also follow the traders blog on the website here from Admiral Markets, and there you had this idea already since Wednesday. So this is a pattern which occurs during the time span from the 23rd of January till the 14th, 13th, 14th of February, so around 3 weeks. But so there's also this leverage restriction. Let's come back to that here on CFDs like DAX 30, for example, or gold, for example. And so there's a chance for retail clients to recategorize or be recategorized if certain criteria are met. Then to become a professional client. For further information also here, please feel free to contact Admiral Markets directly. What's the most important aspect here, and there you can see it's not only the leverage which is important in terms of the ESMA decision, but it's also the negative balance protection. As a retail client, you have an unlimited protection against negative balances. If you're categorized as a professional client, sure, you have no leverage restrictions, but usually you do not have such a negative balance protection. This is something which is really interesting here in terms or in regards to Admiral Markets. They offer up to £50,000 according to their policy, such a negative balance protection. Also here, feel free to reach out to Admiral. This is a very, very interesting offering here. for professional clients in this case. So the face to the voice currently speaking here, that's me. And then I'm currently located here in Berlin, Germany too. This is, by the way, also one of the cities where Admiral Markets has an office. And what I can say here is in Germany, when talking about Admiral Markets, we refer to Admiral as the so-called DAX expert. They have a highly competitive offering, probably the best out there in comparison to other CFD brokers, with a typical spread of 0.8 points during the main trading hours, very fast order execution. So it's definitely worth to give Admiral Markets, if you haven't done so yet, it's definitely worth to give Admiral Markets a deeper look here. Yeah, as I already mentioned, office in Germany, but there's also other offices around the globe. Here, Admiral Markets is not only registered, for example, here by the FCA in Great Britain, but also, for example, by the Australian financial service, or has an Australian financial service license, for example. They also have an offering there. Chile is also a place where Admiral Markets offers business. So for further information on this, again, website, and feel free to contact Admiral here via these contact details. And now let's move over to the action. Let's have a look at our agenda for today. So the questions we want to answer are: what are the key economic events in the coming trading week, which are important, which can potentially drive the markets? It's the first Friday again. That's next week on Friday then. So when we have our next weekly market outlook webinar, we also want to have a look at the non-farm payrolls. There was I have to say it's a strange development when politicians start to talk about the upcoming employment situation already and the numbers which will be published there. That happened already in last year when Donald Trump, the US president, tweeted a number. Or I'm not sure whether it was a clear number he tweeted, but nevertheless, he said that numbers will be good. And that was something, well, it's kind of insider trading to some extent. Even if he has the information, I think he's not allowed to share it then via Twitter. So that happened last year. Nothing bad happened, let's say. Yesterday, I think his position as chief economic advisor, if I'm not mistaken, Mr. Kudlow did the same, referring nevertheless to the initial jobless claims from yesterday, which came in at the lowest level since 1969, so nearly since 50 years. But all in all, it's somehow weird if politicians leak such data sets here, and then potentially having an impact on the markets. Nevertheless, we want to have a look at the NFPs, why they are interesting, but there's also other important events next week. Brexit vote again, for example, in the UK Parliament. There's also the trade negotiations, as I already mentioned, between the US and China, and all this is currently what we want to have a look at. And sure, based on that, we want to see how it impacts the current bias in the FX and equity commodity markets, and then also which trading opportunities may arise, even though one was already presented in a, yes, sure, very, very exotic currency pair. But for illustration purposes, you can see here, I just took a long position here in CAD JPY, and probably we start with this, even though it's a very exotic currency pair, but probably I give you some thoughts on what's currently happening here and why I took the trade, and why I'm targeting this range or this region here around 83.50, 83.70. We don't want to dig too deep now into the overall central bank policy here from the BOC or from the Bank of Japan, even though there could be now something interesting be drawn probably out of the comments from the BOJ at the beginning of the week. They had also their rate decision there, even though, yeah, I said it could be that we can draw something interesting out of it, even though we have to say they didn't deliver anything new at all. And so it's really something where we only want to have a look at here. We want to look at this from a purely technical, from purely sentiment perspective. And therefore, I suggest you to go to the website from admiralmarkets.com, and then you can find here via the top analytics, in this case, the traders block. And if you scroll down a little, you can see here that was already published on Wednesday. There's this short piece on all the numbers I will present you now. And the headline already speaks for itself. CAT JPY bulls about to enter a very favorable period of the year. And what do I mean by that? So in fact, this is this paragraph here. I probably just read it aloud here. So, in fact, over the last 23 years, CAT JPY has increased overall within the time span of the 23rd of January till the 13th of February within 20 years, or 87% of the cases, with an average gain of 151 pips, while on those 3 occasions when CAT JPY dropped within this time period here, it lost on average only 50 pips with a max drop, or we can also call it the max DD, of 94 pips. So with this seasonality in mind here, and also seeing that currently the markets seem to be quiet. So it's a very, very difficult spot. So I think from a psychological perspective, we know that there is still some tensions, let's call them, between the US and also Canada in terms of trade. I mean, yes, they agreed on a, let's call it renegotiated NAFTA deal. All in all, nevertheless, there's still some tensions. And we can also see after yesterday, especially, something we want to have a look at in a few minutes then, in regards to the ECB and why the DAX took some time, especially the DAX, but also the Euro. The DAX to move on the upside, the Euro to move on the downside, even though we can definitely and fairly say that the statement from the ECB was quite dovish. Why the market did not react, or reacted in a complete different way. So at the first moment, I was irritated, to be honest. But then I saw what happened right at the time when Mario Draghi stood in front of the press, and the press conference was held at 2:30 p.m. German time in this case. So at the same time, there was here an interview from Wilbur Ross. He's the I think it's a Commerce Secretary, if I'm not mistaken, U.S. Commerce Secretary. And he said that the U.S. and China are miles and miles away from a trade resolution, and that resulted in a short push on the downside. It also explains, for example, why JPY was quite strong around this period. So, in fact, I had a short position in Euro JPY on. And it moved in my direction initially, and then it bounced aggressively back. Took some time also here into the evening, so it wasn't stopped out of this trade. And to be honest, I had already given up on the trade, and I wasn't really expecting anything from it anymore. And into the evening, then the market moved in my direction, and I finally made 1R, which was still a big success to this time after this bounce back after the initial drop lower. But the drop lower in the Euro JPY wasn't initiated by Euro weakness, but it was more like JPY strength, based on this comment here from Wilbur Ross. So that said, we should definitely go back here now to CAT JPY first. So now the question here is, okay, why is this a difficult period right now to enter long engagements? First of all, trade negotiations are not going really well between the US and China. And so based on that, we can also draw some conclusions. It probably has, where there's also some tensions, let's say, between the US and Canada. Even though they're probably, and after the renegotiated NAFTA deal now, they are not as tense as probably between the US and China, or probably also between the US and the Eurozone, but still they are there. We also know that there's a high positive correlation between CAT and WTI, so oil, which we haven't a chart here. I don't want to go into too many details right now here and present you too many charts. So we just skip the WTI's chart. But as you probably have seen, there was a sharp drop from the beginning of October, and we lost nearly 40% and bounced now aggressively back. And there's a high positive correlation between CAT and WTI, respectively CAT JPY. So here you can also see that was usually, or not usually, that was initiated by the flash crash in JPY crosses at the beginning of the year, 2nd of January. But nevertheless, there's a high positive correlation between those two assets. And now after this sharp bounce back, the question remains for WTI if this is this a sustainable move, or will there probably be another leg lower, which could then also weigh more heavy on CAT in this case, on the CAT, and then be unfavorable, let's say, for CAT JPY long engagements. But if you put all this aside and just focus on the stats and just focus on the facts, at the end, the seasonality is still given, which is very positive for CAT JPY, and therefore, let me just probably, even though we won't go into too many details now and have the theory, let's say, behind expected value and everything around this topic. But what we know is that the expected value, its EV, is calculated by the average gain and then multiplied with the hit rate. And then we subtract the average loss, and which we multiply with the loss rate. And if you now put in those numbers, which are written down in the article, we know that the average gain was 150 pips. And then we multiply this with 0.87, which is 87%. And then we subtract 50 pips on average. This is the loss. And this is what we, this is what we multiply with 13% then. This is when we lose. It's only 4 out of 23 cases. And now if you, let's probably do it that way. If we calculate this, it's 150 multiplied with 0.87. This is 130.5. And then we subtract 13 multiplied with 50, and we only subtract 6.5. And as you can see here, on average, with this seasonal pattern over the last 23 years, we made an average gain of 124 pips, which is bigger 0, which means this is a profitable setup, but it perfectly illustrates what I mean by highly profitable setup and then highly profitable period. And yeah, so what I did, in fact, was now I look at the overall technical situation. I see, sure, we have a sequence of falling highs and falling lows, so we definitely have to say that this is currently an anti-cyclical long engagement. Nevertheless, there's still a good chance, especially if we now make it back above here, those highs which we marked on the 21st then, those weekly highs which can currently be found at 82.90, that further gains are likely, which will push us as high as 83.50, 83.70. And now the interesting thing comes into play. When we started this engagement, you could add the average gain here on top of the entry price, and then you were here right in this region around 83.50, 83.70. Depends a little on where you entered the trade. So I went per illustration purposes aggressively long on Wednesday usually, and the correct entry, let's call it, would have been on the last trading price of the day, so which means 11 p.m. German time, or 10 p.m. London in this case, on Wednesday. And there we traded slightly lower. There we traded around 82, if I'm not mistaken, 82.20 or something, or 82.10. And if you add 100 pips here, you will nevertheless still come out here at this region. And this is one way how you can trade such seasonal patterns. And yeah, let's just see if it plays out or not. So the pattern, again, now let's go to the traders block. The pattern is valid here from, again, the 23rd of January till the 13th of February, so one day before Valentine's Day. And let's just see if it plays out or not. Again, it has a high hit rate, as we have seen, a very high very high hit rate over the last 20 years. And I think even though it's a very, very exotic currency pair, it's still a very interesting setup and something to probably look for, which is also, by the way, something which is interesting for gold currently. you probably recall that I was and I'm still bullish for gold. And as you can see here, I put it purely technical when I said 1,275 to 1,277 on a 4-hour chart. As long as you trade above that level, I consider gold to be positive, and there's a higher chance that we break out above 1,300 USD than we break below. And there is not only a fundamental potential driver with the US shutdown, in my opinion, which gives enough uncertainty to favor gains in gold, but also from a seasonal perspective. So we are still in a very, very favorable environment for gold long engagement. So in fact, we are in this favorable seasonal environment since mid of December. In fact, that's when where it started. And this seasonal pattern we're currently in also ends at the 10th or 15th of February. So I don't have the concrete number in mind right now, but still with the combination is very favorable for gold, and one of the reasons why I'm currently positive, and I think we'll break out above 1,300 USD. This is, by the way, also something you have to keep in mind. Currently, probably some of you might have a look at the US dollar index future and see the US dollar index future gaining. Not sure whether it's really strength, what we get to see here, or it's not, or it's very likely that it's weakness, especially from the euro. So in the basket we're looking at, when looking at the US dollar index future, we are looking at a basket where the euro has a weight of 58%. And with the advantage being found on the downside in the euro currently, especially after the comments from the ECB yesterday, we have to say that further losses in the euro should be expected, which then naturally will most likely drive USD index future higher. And usually you say there's a negative correlation between the US dollar and gold. And so if the US dollar moves higher, you do not really expect gold to push higher then. But in this case, it's not USD strength, but it's more euro weakness. And nevertheless, we definitely see that gold really can't take off and does not want to make it above 1,300 USD. But this could change, and there's a positive correlation. Some of you probably know about that. There's a strong positive correlation, currently at least, between the Chinese yuan renminbi and gold. And the Chinese renminbi had some trouble into the start of the year, let's say. And I think one of the reasons for that is also the still tense trade negotiations between the US and China. And if there's no solution found next week, then I think this potential break higher in gold will be delayed. But then we have a very good chance that the yuan renminbi will probably take on momentum, and this is also something which could then translate into strength in gold, and see gold pushing up to 1,300 USD and probably even higher. Especially because, or also, what you could argue in this context is that such a deal would most likely in some way try to push the US dollar lower and give the US some kind of advantage here from a currency perspective or from an export perspective. And this is also something which could then mean higher gold prices in this case. So that's definitely something you should keep in mind. If those trade negotiations end favorable for both sides and the yuan renminbi strengthens, then it's a very good chance that also gold will probably push higher. Short-term, interesting level, sure. This current region we are looking at, 1,286. Make it above that. Further gains in the days to come are likely and probably will push us here to this region. So, okay, now let's have a look at the most traded market here. In terms of trading volume, and many people look at, especially when trading indices, it's the DAX 30. So last week, we've seen this sharp breakout here, and the explanation for this was also, and still is, that it was mainly hedging based on the small expiration we've seen in the in options of the DAX at the Eurex. This is where the FDAX is traded, and what was very interesting was that I said, well, after this push higher, we now have to see whether this was a sustainable move or not. If we can really stabilize at that level, or, and that was the favorite scenario from my end, or we probably see a retest of this breakout region. And this is exactly what happened. So at the beginning of the week, on the small time frames, I was willing to take some short engagements. They didn't really play out enormously positive, let's say. So yes, there were some points to be made, but it wasn't really that we've seen a strong trend. That was a first sign that probably the move was more sustainable than initially thought. Nevertheless, there was not enough demand now to stabilize us at an elevated level. And so the market really tested this region again, and then we could see that it stabilized against this level. And not only it stabilized against this, but it took on again. And yesterday then took out the level at 11,150 points, which pointed, and that was something we also pointed out in our technical piece in the morning, also to be found in the traders blog section on the website. So it's every Monday, Wednesday, and Friday in the morning around 8 a.m. German time, 8:30 probably. You will see here something. You'll find something, and there you can see it with another test of the pre-weekly highs. In fact, when it was published, the market traded already into this region. So we started very strong and above 11,150 points in the DAX today, and then just moved higher from there. So never really looked back. And so now the question is, nevertheless, what's the current driver? So where is this momentum coming from? I mean, from a pure technical standpoint, you can easily argue what's going on here. So you can say, okay, it's a structure of higher highs and higher lows. We break out above this strong zone of resistance, let's call it, and then we see a retest and then stabilize against that and take off again, and now we take out these highs and see a ongoing sequence of higher highs and higher lows. So from this perspective, nothing really spectacular. But what's currently the fundamental driver behind this? Because today there's no small expiration, and here we come to the ECB from yesterday and comments which in fact did not deliver. Which did not deliver anything new. So in fact, the ECB rate decision didn't deliver any news which we didn't know before, something which we didn't expect. So they kept the main refinancing rate unchanged at 0. They kept the lending facility unchanged at 0.25%, and they kept the deposit facility rate unchanged at -0.4. So this is something which everyone expected, so nothing happened here. We should remember the comments from Mario Draghi in front of the Euro Parliament last week on Tuesday. It was the 18th, right? 16th, 18th? Let me just see. Today's Friday. It was the 15th, I'm sorry. It was the 15th. And so there, Mario Draghi pointed to a weaker economic development and the European economy losing some steam, especially pointing to Germany. And in the morning, by the way, the IFO was published. Therefore, let me just see whether it's still in the headline there. Trading Economics. I highly recommend this website, by the way. Yeah, perfect. Here. So you can see it right in the header. German business morale worsens to near 3-year low. And that's also, again, a sign that there's at least some recessive tendencies, let's say, in Germany. And that was also something Draghi pointed to yesterday. And so all this wording in general, it wasn't something which came as a surprise, but when carefully reading through the statement or listening to the words from Draghi during the press conference, in my opinion, it became clear that the ECB, they clearly stated, by the way, in their statement also that the rate hikes should be expected only after or in the second half, if at all. So they didn't really say if at all, but they said at least, so we won't hike rates before mid-2019. And he also emphasized during then the press conference and the questions from journalists, he emphasized in a very straight and direct way, he emphasized that all tools are still available, and they have everything to overcome any recessive tendencies. So when carefully listening or when reading through the statement from the ECB, you could clearly spot that was all in all a very, very dovish rhetoric they used here. And something you should have expected, and which then perfectly explains why the market currently is taking off and why I don't want to be short in the current environment we find ourselves in the DAX. On the other hand, I don't want to be really long in the euro too. So what I can say from a trading perspective currently, I'm long in the DAX, which I feel completely comfortable with, but I'm also long in Euro JPY. And this is something where I say, well, this is not the position I would be in if it's not a system-based trade. But from a gut perspective, I just skipped the trade. Interesting enough, currently at least, the position is moving in my direction. But let's see where we stand at the end of the day. Nevertheless, the thing is that the comments from Draghi here are bullish for equities in general. And when looking at the current environment here in the DAX, so I think there's a very good chance that we make it at least up to probably 11,370, probably even higher, and go for a test of this let me probably take this line out here. So to this region, around 11,500, 550 around. So we have still some room on the upside, and this is especially true, and there's a good chance that we make it up to this level in the days to come. If, first of all, the negotiations, the talks between the US and China move in the right direction, and there is a deal which is found between the two of them. And on the other hand, it's also a Brexit deal vote where it's still not sure whether there will be a deal or a no deal, but there's more and more points or dots which you can I think combine with each other, which point to a no deal scenario is very unlikely to happen. Depending on how the vote now on Tuesday plays out, I think still May has no chance to get her Brexit deal through the UK Parliament. But the longer it takes, the higher the chances that there will be some kind of deal and concessions from the EU. So nothing has changed here. And that was also something which was underlined by a comment from, oh, by the way, do I have it? No, I'm sorry. I thought I have it. I'm prepared here, but okay, fine. So there's the German, what's his position, by the way? His name is Altmaier. That was funny. I had a webinar yesterday in German, and I was looking for his position, and I again forgot it. So he's at least some of the guys in the inner circle from Angela Merkel, Chancellor Merkel, and he's in Davos right now. That's something I can definitely say. And so what he said was that he sees no problem. He said, I think. He sees no problem that the exit date will be delayed. So it doesn't necessarily need to be the 29th of March, but he's fine with delaying this date into the future here too. And this is something you can hear from several politicians here in Germany. And it's no big surprise. Again, let's have a look here at this headline. German business model worsens to near 3-year low. This is a clear sign that the German economy worsens, that we're running out of steam here, running out of fuel. UK is the 4th biggest trading partner of Germany. We're an export nation. If there's no deal, this has definitely a negative impact on the German economy. German economy is the biggest economy in the Eurozone. To make long things short, it's definitely not in the interest of the European Union here to not find a deal with the UK. And so chances are still high that there will be some concessions made. And the chances rise if there's a no again in the Brexit vote in the UK Parliament then next Tuesday. So that said, this is one positive driver too for the DAX. And so with all these drivers in mind, I think chances are higher that we're moving higher, and long engagements also on lower timeframes should be favored instead of short engagement. So I wouldn't really fade the current momentum. I think there's a high chance that we will push up to 11,500 points, then we'll break lower and go back below 11,000 points here in this context. So there's still a chance, but nevertheless, such a push lower doesn't seem to be an option, at least not now. Nevertheless, also something worth mentioning. Yes, we broke out of this channel, of this down channel here. Yes, and nevertheless, we're still in a bearish environment. So as long as we trade below 11,550, probably push this a little higher and go up to 11,700 points. As long as we trade below that, from a price action or Dow theory perspective, we should consider the overall advantage given on the downside. And this is not more than a regressive move, let's say, so a regression taking place. We're trading below this purple line, which is the simple moving average 200. So all this points to a bear market rally, let's call it, which we get to see right here with the DAX now. Nevertheless, on the lower time frames, pointing to higher highs in this case. So be careful when taking long engagements, but in my opinion, at least, long engagements in lower time frames should be favored, and we have a chance of moving higher, or higher chance of moving higher than moving lower. So now let's have a look here at Euro USD and also pound sterling. I'm surprised by the current performance of the euro again, and it's obvious that my gut is wrong here. Again, I wouldn't be really comfortable. I'm still not comfortable with having long positions. Short-term long engagements in the euro are something I wouldn't favor from a gut perspective. But if the system tells you you're long, well, you're long, and then you just take the signal and let's put this in quotation marks. You hope the best that it plays out. But as I already pointed it out, so yesterday I was Euro JPY short, for example, and the initial stint lower, probably let's go here to the hourly chart. We have the Euro JPY here. So that was the move yesterday, where we pushed lower, and my target could be found somewhere here in this region. It was around 123.50, I think. And so it looked really, really promising. And then it didn't play out, but in fact, the market bounced aggressively back. And while my stop was placed here at these highs, obviously I wasn't triggered. But when this green candle appeared, that was 3 p.m. German time, between 3 to 4 p.m., I gave up on the trade, to be honest. So I kept the trade, and I didn't take any action in terms of taking it out or something. But in my mind, I was already done with the trade. I thought, well, hopefully it will play out well, and at the end of the day, I probably only see a small loss, but I already prepared, on the other hand, for a stop out on the upside. And then, as you can see, that was my gut talking to me in this moment here. Into the evening, it turned out to be a good decision to just hold the trade, because not only did the market test the region around the lows again, but it traded here lower and closed here in the region of those lows. So the trade turned out to be a profit. I didn't hit my target. Nevertheless, the market closed, or the trade was closed here in the region around the daily lows. And today it's the other side. So I definitely, based on what happened yesterday and the comments from the ECB and everything I mentioned in regards to the ECB, that I'd favor, from a discretionary perspective, I'd favor short engagements. But as you can see, market is currently drifting higher, and it doesn't make the impression on me that there will now be a big turnaround, which could surely happen if some risk off move now hits the market and JPY strengthens significantly, or a central banker from the ECB is now stepping up and talking about I don't know, big QE program coming in March or something to counter any negative impacts a hard Brexit or no deal scenario would have on the European economy or something. Sure, all this can happen right now, but right now it doesn't look that way. And also when looking at equities and seeing the DAX pushing up to 11,300 points, you don't really see big supply in the market, but you see demand, and you see markets currently obviously chasing the upside and obviously finding themselves in a risk on mode, and so based on that, you just follow the rules you're given, and probably we'll see higher highs here too. I definitely favor it, and So the gut is a nice thing to listen to. Nevertheless, at the end of the day, you should probably just go with your trading rules you're given and follow these rules. And but let's come back here now to Euro USD. Yes, I am surprised still when looking at the overall price action and the technical picture after the breakout above 115 here, the fake out, we have to call it, and the comments induced by the comments from Atlanta Fed member Bostic. Now we not only pushed lower, but based on the comments from yesterday, it becomes more and more a very high, or there's a high chance, let's put it that way, that we'll probably move as low as 112 within the next week. And the euro will most likely keep on weakening here. So I don't want to be aggressively long. Nevertheless, overall, we are still in a neutral environment. So it's not a bearish environment right now. It would become a bearish one once we push below 112. If we go below 112 in the days to come, for whatever reason, then sure, there is a good chance that we'll move as low as 110 and probably also below that level. But before that, it's an overall neutral environment we find ourselves in, and yeah, in fact, that's it around the euro. So nothing more to add. Pound sterling, on the other hand, has a good chance, in my opinion, based on those expectations around concessions from the EU made, to push higher, stabilize not only significantly above 130, but probably gain or go as high as 132.70, 133. Still, something worth remembering, what we get to see here right now can be considered an anticipation of such concessions made from the EU. So with this in mind, it's very, very important to know that if we now continue moving higher, and then finally the news around a deal being found in regards to a Brexit hits the wire, then we should be really, really careful with further gains. It could then result in a short probably squeeze on the upside, which is then nevertheless sold shortly after. That's something to probably keep in mind. But so far and right now, I definitely favor further engagements here on the long side in pound sterling. On the other hand, and yeah, so in fact that's it. So nothing more to say here from my end. Probably finally we can have a look at here the comments now or yesterday from Kudlow in terms of the January payrolls, where he said yesterday that they may be up a significant amount given most recent jobless figures. Again, I consider this to be a very, very bad sign because it becomes more and more clear that there is some intention from the Trump administration to take any uncertainty out of the market while trying to support it with comments which can only be interpreted in a positive way. So first of all, good job numbers, for example, are a sign the economy is still strong. It's giving market participants probably some confidence in the further economic growth in the US, while on the other hand, chances are not really high, or at least market participants are not giving it a high probability right now that there will be an aggressive ongoing rate hike cycle from the Fed in this year. So yeah, then we have the comments that's already 1 month ago, but still, which should be in our minds, from Steven Mnuchin, who said that he was talking not only to CEOs from big investment banks, assuring that they have enough liquidity available to be prepared for any, let's say, meltdowns in equity markets or a credit crisis, credit crunch, whatever. But also that he said he was talking to a plunge protection. And in addition to that, there was also the comments from Fed Chairman Powell on the 4th of January, which already resulted also in a sharper squeeze higher. So there's many signs that currently the market is, let's call it, manipulated on the upside. And the thing is, this is this is reducing more and more the level of trust market participants give in the comments from those politicians. What do I mean? Well, the moment the market is hit by bad news again, those politicians who should usually be in the position to somehow calm the market down and give some confidence that everything's fine and everything's under control, well, they're not given any trust anymore, which will naturally result in further turbulences and even higher volatility. So this is a very, very bad development, in my opinion, happening here. And right here, by the way, not giving any focus on the fact that I consider it to be difficult, let's say, that an official or a politician is giving such sensible data away over 1 week before the data is finally released. And that's also something what Trump did. Yeah, let's just see how numbers come out next week. The thing is that such a positive number now for the US dollar is probably not as positive anymore as it could have been if he hadn't said anything at all, which is probably, by the way, also a strategy to somehow keep the US dollar lower, or at least not letting it break out on the upside again. US dollar index future then moving above 97 points here, and 98 probably, and moving back towards 100. But instead, yeah, taking out any positive surprises such a job data set could have on the currency in this case. That's it from my end. So I hope you enjoyed the webinar. Feel free to check out the website from Admiral Markets and their traders blog. There are some very, very interesting articles probably. And if you have any feedback, feel free to give the feedback to Admiral Markets. I wish you a nice weekend. Enjoy yourself. Take care. Talk to you again then next week in the weekly market webinar on the 1st of February, shortly before the non-farm payrolls will be released. And yeah, that's it from my end. So have a nice weekend. Talk to you soon. Happy trading. Watch your stops. See you and bye-bye.